Hello friends, good evening to all of you, and let's move to the capital charge for the operational risk. Capital charge for the operational risk. And two methods out of three are very much important for the numerical point of view. One it is basic indicator approach and the other one it is a standardized approach. Previously we calculated the capital charge for the credit risk, and now we are talking about the capital charge for the operational risk. Okay, and when we will be solving the case study about it, it will be much more clear. But let me just give an idea that in case of the basic indicator approach, or we simply say it to be BIA approach, in this scenario we are to get the average gross income for the last 3 years. So if we are having the gross income of 3 years divided by 3 so as to calculate the average, and we have to multiply it with the alpha. Now alpha is what? Alpha is having a fixed value, and the fixed value is equal to what? 15%. Right? So this is a formula related to it. And the second one, it's related to the standardized approach, or SA, or TSA, we simply say the standardized approach, TSA. Right? In this scenario, we are actually given about the 8 different business lines. 8 different business lines, and each and every business line is having the beta associated with it. In case of BAIA we are having the alpha, but in case of the TSA we are having the beta, right? And for 8 business lines we are having the different betas, like beta 1, beta 2, beta 3 and beta 8, right? And if we do calculate the average of all the betas, it will be coming equal to the 15% itself. Okay, but for this case we'll be multiplying the gross incomes with the beta 1 factor, and then we'll be adding them up all. So it is much more, we can say, particular or more sensitive than the BIA approach, right? For the calculation of the AMA, that is not to be covered in the syllabus as per the IIBF. The questions won't be asked related to it. Okay, you just be knowing that the AMA is there, that the advanced measurement approach is there, that is it. Okay, now but we'll be solving the question and case study based upon it, so do not worry, we'll be solving the case study based upon it very shortly. Further, it's related to capital charge for the market risk. Capital charge for the market risk. So if we are to calculate the capital charge for the market risk, it is by the standardized approach maturity method, or the duration method, or the internal model method. From the exam point of view, duration method will be covering in the next unit, not related to this unit, and that is important only, right? That is important. Further, now let's move to the second pillar. Second pillar, that is the supervisory review process. So the main thing is that under the pillar 1, we are dealing with the minimum capital requirement. The word that you should be focusing upon is minimum. It's not about the adequate. It's not about the adequate. Why it's not adequate? Because in pillar 1 we are just concerned about 3 major risks. We are concerned about the credit risk, market risk and operational risk, and none other risk. So it may be the case that there is some residual risk left. There is some residual risk there in the banking sector or in the bank profile, which is yet to be covered, for which the capital is to be covered, right? So that is the part which is played by the SRP. In short, we say the pillar 2 to be the SRP, that is supervisory review process. Okay, so main objective is that the banks are to ensure that they're having the adequate capital, and it is having 2 components. The one component is ICAAP. Make sure you should be memorizing it right now. So it is having 2 components. One, it is ICAAP, which we say to be internal capital. Why I'm writing? It's written down there, but I'm writing over here so that you can understand it, right? Internal capital adequacy and assessment process. Now the name suggests each and everything about it, that what is going to be there. So it is a process which is followed by the regulated entity, which is followed by the bank so as to check that whether we are having the adequate capital as per the risk we are taking, as per the bank profile we are maintaining, as per the product range we are offering, as per the customers who are associated with us or not. So it's a process to check the adequacy of the capital. It's the process to check the assessment, to assess the particular things that we are going to assess as per this model, that we are having the particular capital, yes or no, right? That's it. And the second component for the SRP, supervisory review process, is SREP. Now SREP, it is supervisory review and evaluation process. It is supervisory review and evaluation process, right? And as the name suggests, see, the first part, ICAAP, is followed by the bank. The second leg is followed by the regulator, that is Reserve Bank of India. Okay. So in case of SREP, that is supervisory review and evaluation process, what the banks are going to do? The banks should be reviewing and evaluating this ICAAP model and the strategy so as to evaluate that the capital that we are going to maintain is adequate. First thing that the supervisors are to do so as to evaluate the model, which is going to be followed by the bank under the ICAAP. That's the first thing. Second thing, supervisors must be expecting that the banks are operating above the minimum capital ratios required. Minimum regulatory capital ratios required. The bank supervisory should be expecting the same. And third thing, the supervisors should be intervening at the early age so as to prevent that the capital never goes beyond the minimum levels, goes below the minimum levels, right? So these three things are to be followed by the regulator or the supervisor, we can say. That's why it is said to be supervisory review and evaluation process. The first one, it is ICAAP, internal capital adequacy and assessment process. The second one, it is related to SREP, supervisory review and evaluation process. Clear to you? Okay. Now, ICAAP, as a name suggests, internal capital adequacy and assessment process, I already told you. And ICAAP is related to the bank's procedure, bank's measure, and SREP is related to the regulator. This is related to supervisor, or we can say simply regulator. Okay, is that clear so far? There are some principles, and there are 4 key principles related to SRP, that is pillar 2. For pillar 2, we are having 4 principles. One, it is related to that the banks must be having the process so that they can assess the overall capital requirement for the adequacy purposes, and supervisors should be reviewing and evaluating those internal processes. Supervisors must be expecting the banks to operate above the regulatory capitals. And fourth, the supervisors must be intervening at the early stage, so that the capital never falls below the stipulated minimum levels, right? So those are the 4 key principles, very important, right? It may be asked you in the exam like a statement type question, that which one of the following is not a principle under the pillar 2, right? So such type of questions are asked, right? So you should be clear about one part, that pillar 2 is all about making the process and checking the process, right? So process is to be made by the banks and is to be checked and evaluated by the supervisor. That is it all about. That is it all about, right? Further, the pillar number 3, it's related to the market discipline. The pillar 3 is for the market discipline. Now, in case of market discipline, as I suggest you, this pillar supports both pillar 1 and pillar 2. It is complement to both of these pillars, and it's about the transparency. It's all about the transparency in the system which is to be maintained by the banks. So for that particular purpose, disclosures are to be made, and these disclosures should be at least on half yearly basis, and there are some exceptions related to it which are to be done on quarterly basis. Otherwise, all the disclosures must be there at least on half yearly basis. Only some exceptions are there. Like one exception is related to capital adequacy, which is to be done on quarterly basis, credit risk general disclosure, which is to be done on quarterly basis, and credit risk disclosure related to the portfolios under the standardized approach, that is also to be done on the quarterly basis. So one, it is related to the CAR value, CAR or CRAR value. Second one, it's related to credit risk general disclosure, and the third one, it's related to the credit risk disclosure of the portfolio, right? So these are to be done on the quarterly basis, else all are to be done on the half yearly basis. Kindly please make a note related to it. You should be knowing this. Is that clear to you? Kindly confirm. So we read all basic about the pillar 1, pillar 2, pillar 3. We have already read all about it. If these points are clear to you, make sure to like this video at the earliest, and do share this video among your friends and colleagues who are preparing for the CIIB 2026. We are going to cover each and every single point related to it. Now, let's talk about the CCB, that is capital conservation buffer. So when the banks are going through the normal times, the banks are to prepare a buffer. Buffer is just like a saving that we do for the hard times, right? Let's say you are saving some money, you are saving it for the emergency purposes. Same is the case with the CCB, that is a capital conservation buffer, because it was felt like that the banks must be having some extra cushion with them so that they can withhold with the downturns, or let's say when the economic drawdowns are there, so it can be drawn down, right? So that was the case related to the CCB, that is a capital conservation buffer. And when I told you about the classification, I already told you that CCB is to be maintained in the form of the CET1 capital. Now CET1 capital is to be maintained, right? So same components would be applicable to the CCB. So we can say same components as of CET1 capital. Now in case of CET1 capital, we were having 10 components. From those same 10 components, the CCB is to be maintained. So it will be just like a very good liquidity that will be available to the bank, or capital that will be available to the bank. Okay. And the CCB is to be maintained at 2.5%. It is to be maintained at 2.5%, right? So that is the case. Do not look at this table. Previously it was there, like if there is a shortfall in the CET1, then this particular table was applicable. Like in total, if you are having the CET1 ranging from 5.5 to 5.96875, 5.5 to 5.96875, then you are to retain 100% of your earnings next year. That was the case. I'm just going to explain you, just do not worry about it. So just remember that you are to subtract 5.5 from the first term, right? Here you have to subtract, like you're having the 5.96875 minus 5.5. So it will be equal to 0.46875. And further, this is the range which is given over here. Like go for the second term. It is 6.4375 minus 5.96875, right? That is equal to 0.46875. So that is the point that I'm going to explain, that you should be memorizing 5.5 and 0.46875, and using this term just add on to the last one and you will be able to form the complete table, right? So we will be adding this term to the first one and you'll be getting this one, and further this term will be added to this one and you'll be getting this value, and further this one to this value and you'll be getting this value, and so on, right? And you can be preparing the complete table that is mentioned over here. Now the point is that if we are having the total CET1 as maintained in the tier 1, as maintained under the CCB, if the total CET1 is ranging between 5.5 to 5.96875 for any of the banks, which is to maintain the capital adequacy ratio, right? In that scenario, 100% of their next year earning must be retained. And the second case, if the earning is between the second bracket, then in that scenario, 80% of their next year earning is to be retained, and so on. But that was a previous concept. But because previously it was like that the banks were to maintain the CCB in the trenches of 0.625. There were four trenches which were announced by the Reserve Bank of India, and as 0.625% of the step up was there. Like for each of the trench, banks were to maintain 0.625% of the CET1, right, and exceed in that way. And four trenches are were there, so that was actually equal to 0.625 multiplied by 4, and that was 2.5 in total. That was 2.5 in total, but now it has already been made mandatory, right? It has already been made mandatory that all the banks are to maintain CCB, that is capital conservation buffer, to be at 2.5% out of the CET1 components. Clear? So do like the video and further share the video at the earliest, and simply just do write CAIB. If you want to get the complete pack, complete course related to all the 5 papers of the CAIB, just simply do WhatsApp CAIB and WhatsApp it to the number 83609 I'll be sharing the complete details to you. Like, and you'll be getting the full course videos, chapter wise previous questions, mock test, mega test, PDF notes, each and everything. The case study videos will also be covered, right? So that will be all. Thank you so much and see you again in the next video.